This here is the popular story right now. Technology stocks are incredibly expensive, the AI bubble will burst, but things are very different today compared to the dot-com bubble. What we see over here is the Nasdaq 100 relative to the S&P 500. So how are technology stocks outperforming or underperforming the rest of the stock market? The pessimist says that the current valuations are even higher, relatively speaking, to the peak of the dot-com bubble, and that this has to come down. But there's also another way to look at the situation. During dot-com, prices appreciated extremely quickly, but then came back down. But the long-term upwards trend is still intact. This time, we do not see technology stocks outperforming all other stocks by more than 200% in the span of just 2 years. We just continue on our long-term upwards trend. And there is a case to be made that technology should be growing faster than the rest of the market. Technology is more risky, technology has better economies of scale, it can globalize faster at higher profit margins, and on top of all of that, technology stocks also tend to pay less dividends than the rest of the stock market. So seeing Nasdaq 100 prices going up faster than S&P 500 prices does make sense. Now, I don't dare to make a prediction what story is right here. If we are really in an AI bubble and that will crash, or if technology will just continue to grow at its past rates. What I want to talk about in this video though is, does it make sense to get into individual tech stocks? So let's say we are diversified. Let's say we own some crypto, we own some gold, maybe some property, and also some tech stocks. Should we just buy QQQ, which is the leading Nasdaq 100 ETF? Or should we buy individual tech stocks? So say Amazon or Google or Tesla, etc. From the crypto space, we know that returns concentrate towards a few winners. The vast majority of altcoins tend to underperform Bitcoin and Ethereum. Is the same true for the leading technology stocks? Because that's in the end our benchmark. Should we just buy the ETF or should we buy Nvidia or Apple or Microsoft or Amazon individually? Let's have a look at relative valuation charts of those companies. Something you've probably not seen discussed in any other video yet. Let's start off with number one. Let's start off with Nvidia. This is Nvidia relative to the Nasdaq 100. The chart starts in 1999. The rallies in the 2000s were mainly fueled by PC gaming, so GPU demand for enabling entertainment on personal computers. The rally in 2015 was mainly enabled through crypto mining. So Ethereum was a proof of work cryptocurrency at the time, and so demand for GPUs skyrocketed. And then, of course, in recent history, it's the demand of AI that's fueling the Nvidia price. We can clearly see how Nvidia tends to outperform the Nasdaq 100, but we did have our tough years as well. From the year 2002 up until 2016, the two assets just moved in sync. So by no means is it safe that we will continue to see outperformance. Nvidia is already number one, and there have been major crises as well. This is an underperformance versus the Nasdaq 100 of 83%. This here is a crash of 76%. What about Apple though, right? Apple seems to just continuously grow under Tim Cook. It doesn't seem to take too many risks. It doesn't seem to scale relatively consistently. What about its performance relative to the Nasdaq 100? The answer is, since Steve Jobs came back, we really didn't see that much of a crisis in Apple anymore. Apple tended to outperform the Nasdaq 100 very consistently by more than 12,000%. But unfortunately, the growth is slowing down somewhat. It's of course much easier to double and triple a company in value when it's much smaller in market cap compared to today when it's the second largest technology company on the planet. It looks like in the short term, Apple is more or less in the middle of its trading range. It's not necessarily super cheap, it's also not super expensive. This range is roughly a 2x in magnitude, so 100% to the upside or 50% to the downside. So I think it is reasonable to hold Apple over just QQQ given its long-term trajectory. Every year, it tends to outperform the Nasdaq by roughly 5%. What about Microsoft? Also a very stable technology play. Bill Gates never took too many risks. Neither does Satya Nadella today. And so because of that, we also don't see that much outperformance anymore. Microsoft trades in line with the Nasdaq 100. This was the Steve Ballmer period. This is where Azure and cloud computing got some traction. But it seems like that market has matured. There was no more additional outperformance in the last 5 years for Microsoft. So not necessarily worth the additional risk, at least if history is any indication. What about Amazon? That's the relative valuation to the Nasdaq. No outperformance for the last 8 years, which could be indicative that Amazon now is a very different beast to compared when Jeff Bezos was still the CEO. I'm not sure if it's worth it to have idiosyncratic risk in a single stock when that additional risk doesn't get compensated. So thumbs down for Amazon for me. Let's have a look at Meta, because Meta went through various crises. This was the initial dump after Facebook launched a terrible mobile app. They had a web-based mobile app that they launched both on Android and Apple, which performed really poorly. Then they changed their development. Suddenly, the Facebook app was used much more. A few acquisitions came, like Instagram, like WhatsApp. That helped the company massively. This was then the bet on virtual reality. The company lost billions and billions of dollars, then scaled back their VR efforts, and that was very much appreciated by the market. Meta was able to recover completely. But now when we are at this valuation again relative to the rest of the technology sector, does it still make sense to buy Meta? Will the bets on AI infrastructure pay off in the short term? Because that's a major problem that we also saw with the .com bubble burst. It's not like the internet isn't relevant. It's not like the story itself was a problem. The internet is bigger than it has ever been. The problem was only timing. It was short-term overinvestment. Many internet companies went bust during that crash. And so there's a very good chance that artificial intelligence will even more important than the internet in 10 or 20 years. But will it be able to make money in the short term, or will it potentially deflate the same way as the internet did before it actually came to the real growth? That's the potential concern. Now here's a technology company that does not get enough coverage, and I think wrongfully so. Broadcom is the 6th largest technology company in the Nasdaq 100, and have a look at their chart. Isn't that impressive? Very little volatility relative to the Nasdaq 100, very consistent outperformance as well. Yes, there are periods where Broadcom just went in line with the Nasdaq 100. This is 5 years of data, but the volatility isn't too bad. This year is a 32% drop. This year is a 38% drop. It's much less compared to what we see with Nvidia or with Microsoft, or dare I say it, with Facebook. Broadcom is the hidden champion in the Nasdaq 100. It's the only stock that's able to outperform the rest of the market while not getting into too much risk. Isn't this a very pleasant chart? So I'm a fan of Apple. I'm a fan of Broadcom. What about Google? Here's the chart. Google relative to the Nasdaq 100. Like Microsoft, Google doesn't take too many risks. It is able to do better than the Nasdaq over the long term, but unfortunately in the short term it is quite expensive. It's probably better to wait for the next crisis when Google underperforms the Nasdaq by another 30% and then buy the dip, because while we do have constant outperformance, it's only 25% over the course of 14 years. So a bit under 2% per year. If Google was to suddenly drop by 30%, then that's 15 years of outperformance burned into the ground. So for Alphabet, we have to find a better entry opportunity. But in general, it does potentially make sense to take the idiosyncratic risk. This video here is on YouTube, and YouTube is also owned by Google. Now let's continue with Tesla. Tesla is a very controversial stock. There are the die-hard fans, the supporters of Elon Musk, and then there are the people that short bought the stock and that got burned several times. What we've got over here, that's the Tesla performance relative to the Nasdaq 100. And there are two major rallies. This year is when the Model S production started to ramp up. And this year is when Model 3 started to ramp up. Without a major success story, Tesla tends to bleed because of R&D spend, because of taking risks that don't pay off. And it seems like in the last 5 years, we have been exactly in an investment phase again, not in a monetization phase. The last dry period lasted 6 years roughly. And if we count early, we are currently in the 5th year. So where are we going to see the next phase of growth for Tesla? The bet is on humanoid robots or on self-driving. Both of those projects are still on very shaky ground. I am not a fan of taking that risk until we see convincing positive news. There was more than enough time to buy into Tesla stock when the Model S production ramped up. There was also more than enough time when the Tesla Model 3 experienced all of that demand, where Tesla couldn't even build enough cars to fulfill all of that demand. They were too slow to scale. It took several months to get your Tesla car. I think before the next potential growth phase, we are going to see some convincing positive news. So maybe an order of 1,000 humanoid robots for a factory of an external company, or maybe broad-scale deployment of self-driving at the scale that at least Waymo is currently operating at. If we don't have news of that kind of caliber, I don't think it makes sense to take the risk right now. But there is of course a chance that we get another leg up, that one of those moonshots will pay off. But we can simply wait until we get the first signs of such success. There's going to be plenty of time, right? This rally here lasted 1.5 years. Let's get into Netflix, Palantir and AMD. And everything below that is probably already too small to take the idiosyncratic risk. Here's Netflix relative to the Nasdaq 100. Netflix has been outperforming even though there had been massive volatility, right? This was a crash of 85%. So it hasn't been smooth sailing, but Netflix has been around for a long time. They didn't start with streaming. They started with sending out DVDs. Now, isn't it fascinating how those data points always align quite well, right? This is 4 bottoms and the exact parallel line also aligns those 2 tops. I don't think this is coincidence. I do think that enough people trade based on opportunity costs. Now, Netflix isn't necessarily historically expensive, but it's also not yet a perfect entry opportunity. Netflix could fall by another 35% relative to the rest of the tech sector. Before then, potentially bouncing, because maybe if the thesis is right that there's overinvestment in AI, Netflix might benefit from that because it didn't do those massive hundreds of billions of dollar investments. What about Palantir, a very government-friendly R&D/information-based company? In the end, its future is based on government contracts. Palantir does a lot of very controversial bets. They also bought a lot of gold before the rally. In the last 2.5 years, Palantir was able to outperform the Nasdaq by 1,200%. Not necessarily something that's too predictable. If you have deep insights into the business dynamics of Palantir, then by all means the current momentum is positive. But if you don't have any edge in this market and other participants are more informed than you, then there is of course quite a bit of risk here. We don't really know how the contracts will develop over time. At least I don't know that. Maybe you do. Let's go with AMD, the main competitor of Nvidia in the AI space. AMD did not profit as much from the boom. It was struggling massively up until 2015. Since then, we do have outperformance, but again, there's so much volatility here. There's also the risk of a potential correction if the AI bubble does burst, and it seems to have already lost the competition with Nvidia. Nvidia is taking the vast majority of revenue caused by the AI boom. Now, most people try to beat the market by reading the news or by following the narrative of the day, but I don't think that that's a good approach long term. Most people just follow their gut. I think it's better to use statistical data analysis try to figure out what kind of rules worked in the past that might continue to work in the future. So you might know about this. I have back-tested moving averages for Bitcoin to try to find out when are we bullish, when are we bearish. It's a trend following strategy. We buy whenever we are above the moving average. We sell whenever we are below the moving average. Now I've back-tested all moving averages from the 2-day all the way to the 200-day. And the 125-day simple moving average and the 44-day simple moving average are the ones that historically work the best. That's the two moving averages we see plotted over here. So the 125-day is the line in turquoise, the 44-day is the line in orange. Now have a look at the historical performance versus buying and holding Bitcoin. So we are betting on rising prices whenever we are above. We're betting on falling prices whenever we are below. This is the 125-day. Buying and holding Bitcoin would have given us this performance here in white, but the backtest gave us the performance in turquoise. Here's the same for the 44-day simple moving average. We can see, first of all, that we outperform long term, but also that our volatility is lower, as in the drop from top to bottom is less compared to buying and holding Bitcoin over the same time period. Now, when we've got an approach that tends to perform more and still is less volatile, still drops less compared to just buying and holding Bitcoin, why don't we lever this up? So I tried to find the optimal leverage. If you go long, the best leverage is 2.75. If you go short, the best leverage is just 1x. If you have the same leverage for both directions, long and short, then 2.25 is the best. But in general, I think it's better to have different leverages to go harder on the long than on the short. So this is the 125-day simple moving average. If we only go long, we never go short. So whenever we are below the moving average, we're just in cash, we're just going sideways. And here is the short side. So we never bet on rising prices of Bitcoin at all. We're only betting on falling prices. And of course that underperforms buying and holding Bitcoin. But still, it shows us that even though in a long-term appreciating asset, if you can only bet on falling prices, we can still make some return. And so let's say we use the 44-day simple moving average, but we don't just have 1x leverage. So that's that. But instead we lever this up with 2.75 on the long side, with 1x on the short side. This is much better than just going 1x. And again, this is a logarithmic scale, right? So each horizontal line here is at 10x from each other. So that's my preferred medium-term approach for Bitcoin. I just look at where is the price currently relative to those moving averages, and then I position myself in the long or short direction. And because this might be cumbersome, this might be complicated for a few people to always enter and exit those trades, I've also opened up a capital trading pool for the premium members. I can simply just deposit capital and then I will execute that exact strategy and I won't deviate from that strategy. So if history is any indication, we might get performance that looks similar to that over time. At least that's the idea. We don't want to just follow the news or act based on gut feel. We just follow rules that historically worked well. This was a very quick rundown, but there's way more details in the tutorial section of Premium. The link is down below. It's bitcointrader.com. But I'm also sharing my personal view on the market regularly. So every 3 to 4 days, I publish a Premium update video where I share what kind of trades I open, where I share what kind of positions I take. There are more details regarding the strategy in Premium. They're dedicated videos for that. There are also dedicated videos that explain how to actually run the backtest, how to make those backtests yourself, if you want to do this maybe for Ethereum or for any other crypto asset. And so here is the Bitcoin strategy moving average vault. So that's the trading pool. You just deposit some money into that pool and then I will execute those trades automatically for you. So feel free to check it out. It's currently $125 per month. There's also a 1-week money back guarantee. So in case you do not like Premium, just message me within 1 week and I will refund you 100%, no questions asked. A link to Premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.